Good morning, everybody. My name is Anthony Kazazis, and I am the director of the NYC Network Group as well as the NYC Real Estate Expo. And I'd like to thank everybody for registering for today's webinar, Using BRRRR Strategy to Build Your Real Estate Portfolio, sponsored by RCN Capital. RCN Capital LLC was established in 2010 to provide time-sensitive bridge financing to real estate investors to fund the purchase of non-owner occupied residential and commercial properties, provide bridge loans, and provide real estate backed lines of credit. Formed towards the end of the recession, RCN Capital has benefited from a turbulent housing market in which many real estate investors see great opportunity. A lack of liquidity in the credit markets and an increase of regulation of the banking industry has restricted conventional financing as an option for investors in the fast-moving and competitive real estate markets. As the nation's premier private lender, RCN Capital helps fills this void. As an active real estate professional, you've probably encountered the acronym BRRRR, which stands for Buy, Rehab, Rent, Refinance, and Repeat. While you may have an understanding of this investment strategy, how do you successfully execute this strategy and set yourself up for long-term success? Here today, we have Connor Hibbs, Business Development Coordinator, who joined the RCN Capital in fall of 2019. He brings adept critical thinking skills, superior communication skills, and a desire to build and maintain strong customer relationships. Connor's mission is to amplify RCN's presence in the local national markets. Welcome, Connor. Today, Connor will go over part 3 of a 3-part webinar series that will take a deeper dive into how to successfully navigate this process so that you could grow your real estate portfolio. On the first webinar in November, Connor discussed buy and rehab. The second webinar in December, part 2, Connor discussed rent and refinance. And now, part 3, repeat and build your empire. I asked Connor today to invite one of their special clients to share their working relationship with RCN Capital on the process of completing one of these BRRRR products. Today's Connor's special guest is Timothy Maloney, president of Quickline Capital Partners, Inc. Timothy, please tell us a little bit about yourself and your company.
Sure. Thank you very much for that, Anthony. So it's Tim, and so I'm the owner of Quickline Capital Partners. We're an expert in alternative finance. Although we're based in upstate New York, we're basically doing loans throughout the United States. 20 years ago, I was working in private equity, and things were good, but I decided I wanted to strike out on my own. Did so and really was focused in asset-based lending for a time. Then along maybe 6-7 years ago, became familiar with Connor and the folks at RCN Capital, and really pivoted my business to where I am today, which is 90% of what I do is around this whole BRRRR strategy. The reason why I really like that pivot and still love it to this day is, aside from helping people, build wealth and build their retirements and these beautiful portfolios, think about it. If I get a client, sometimes that client is good for 15 or 20 loans per year, as they're building these portfolios. So unlike the asset-based side, this is a lot of repeat. The R in repeat, right? It's probably my favorite letter of the alphabet these days. And really that's Quickline's focus. Again, we do like to call ourselves experts in this space because we're not only, we're not only lenders, and we not only work with companies like RCN Capital, but we're also doing it ourselves too. So I myself have had 11, and I really understand it and really feel a lot of what the investors are going through.
Thank you, Timothy. Hey, guys, without further ado, I'd like to introduce you Connor Hibbs.
Hello, thank you for having me. And thanks for hopping on with us today too, Tim. Really do appreciate it. You have a ton of knowledge in this space, and I'm really looking forward to picking your brain a little bit more.
All right.
I believe last time we had this webinar was in November, so it's been about a month and a half. So today we're going to be going over part 3 of the series for how to broker the BRRRR strategy. Part 3 is going to be repeat, so it's going to be using this strategy to grow your portfolio. Again, my name is Connor. I'm the business development over here at RCN Capital. And again, we have Tim Maloney from Quickline Capital today. So to go over what we're going to be covering, today we're going to be reviewing the process. So we'll be going over everything briefly that we went over in the last two webinars. Then we're going to be going over portfolio loans, how you can use them, what exactly they are. And then we're going to be looking at the profitability of each program, sort of comparing what if you were to go about only fix and flipping, what if you were only going to purchase and hold versus using the BRRRR strategy. And then in the end, we're going to be going over some recommendations, some tips, advice, and answering any of the questions that you guys might have. So without further ado, as we usually start this, what is the BRRRR strategy exactly? So BRRRR is an acronym for buy, rehab, rent, refinance, and repeat. Today, we are going to be emphasizing the repeat aspect. So we're going to be looking more into how to turn this strategy not into a one-time thing, but into something where you're really growing your portfolio and increasing your net worth. So to briefly go over the purchase aspect, so what you're going to be using with RCN is going to be the ARV program, also referred to as the fix and flip program. So with this program, your clients are going to be able to get up to 90% of the purchase price plus 100% of the rehab, so long as that total loan amount doesn't exceed 75% of the after repair value. Now with this program, there are no prepayment penalties. So once you're done completing that renovation, you are able to refinance or sell the property without incurring any sort of prepayment penalties. This is going to have a 12-month term. There is a 6-month term extension available. However, that is going to be on a case-by-case basis. Rates for this program are now as low as 7.74%. And we're going to be looking for a minimum FICO score of 650. Now, I will say with the leverages and interest rates for this program, they are going to be primarily experience-based. However, we are also going to be looking at the area of the property just to make sure that the ARV estimate is accurate or at least consistent with other properties in that area, as well as taking a look at the FICO score just to make sure that it does meet our minimum requirement.
Connor?
Yeah.
I think you left off a very important point, especially in today's marketplace where inventory is truly at a premium and a shortage, is your speed. I think that that's probably one of the best selling points of this program.
Yes, so this program is very quick. Really, the longest part of the process is going to be getting that appraisal back to us. Once we have the appraisal and all the documents, it's really only going to take a week. But the appraisal is going to be the longest part of it, but this is a very quick process to get this loan in place. Now to briefly go over our 30-year program. So with the 30-year program, we are primarily going to be looking at the cash out refinance option while using this process, the BRRRR strategy. However, you can get up to 80% of the as-is value for purchases or refinances and 75% of the as-is value for cash out refinances. Now, this is also going to have that minimum 650 FICO score requirement. However, the minimum property value requirement is slightly higher with this program, as we are going to be looking for that minimum property value to be at least $100,000. The loan size is going to range from $50,000 to $2 million, and we are going to be looking for a DSCR or debt service coverage ratio of 1.1 or greater. So where that 1.1 will come in is typically if it's sort of borderline as is when it comes to the points on closing. This is a program where you can go as low as par for points to RCN. However, that will, as I mentioned before, there is an inverse relationship between points on closing and the interest rate. So where this 1.1 will come into play sometimes is if a borrower is looking to pay fewer points on closing, that will decrease the DSCR. So that is an area where this can pop up, but really we're just looking to make sure that that debt service coverage ratio is at least 1.1 or higher. Now, with this program, the leverages and interest rates are primarily going to be based off of the borrower's FICO score. So in order to get that top bracket of 75% on the cash out refinances, we are going to be looking to see at least a 720 plus for the FICO score. However, we can work with FICO scores as low as 650.
Hey, Connor?
Yeah.
Just wanted to jump in. So one of the things that I love the best about sending loans to RCN is that, you know, we do have occasionally somebody will come to us with a 625 FICO. And by adding a credit partner, husband, wife, mother, you know, business associate with a stronger FICO, that we're able to get them into this program, right? So unlike some of the other lenders in this space, you're able to allow credit partners and to get somebody who otherwise wouldn't qualify funded.
Yeah, absolutely. And that is a great strategy too. If your borrower is not even necessarily below the 650 mark, but even if they're barely at 650, maybe like 660, bringing in that other partner can really help them to get that additional leverage and the lower interest rate. And oftentimes that can be more useful than just having them go by themselves and getting that lower leverage and higher interest rate. So that is a really good point to bring up there, Tim.
And just to, because I know from my experience, not everybody's going to be familiar with the debt service coverage ratio, that DSCR. Ultimately, all that is how does the property perform? You know, so long as the property is making money, essentially, it's going to be a deal that I think that RCN would like to fund.
Yeah, absolutely.
Just don't want you getting too technical today.
I'll try not to. So now jumping into the portfolio loans. So what exactly is the portfolio loan program? So the portfolio loan program is a way for you to consolidate multiple properties and multiple loans into one loan. So really this can be used if, say, your borrower has a couple of properties that are on stabilized bridges, another property that's coming up to its maturity date, and then they just have a high interest rate in another property. This is an area where you would be able to consolidate all of those properties under one loan with one interest rate and one payment. So really that's what the portfolio loan is used for. Now there are several ways that using that portfolio loan can save you a bit of money on not necessarily the closing costs, but things such as the legal fee and in some situations the appraisal costs. Now, looking at when you should consolidate your properties into one loan. Now, Tim, I don't know if you have any situation where you would highly recommend your clients go into a portfolio loan.
So I just have one very recently. The gentleman's got 250 properties. They're legacy properties, right? He has no intention of ever selling them. This is going to be something passed down. The LLC will eventually go to his children, and he was fine with, you know, having a pretty long investment horizon, meaning more than 5 or 6 years, right? So what was a huge benefit to him was, aside from getting a better rate, it was getting one check. He's writing, well, it's an automatic transfer, but it's one payment per month for not all 250. He's going to do about 200 of them, but it's enabled him to just streamline the operations on the accounting side, to go from, you know, checks with, you know, 80 different lenders to just one payment. Aside from the fact, again, he saves a bunch of money with the interest rate, one closing, one set of legal fees. So it's a great product for somebody who has a longer investment horizon than, say, 5 years. If you're shorter than 5 years, I wouldn't recommend this.
That actually brings me right up to the next bullet point, which is, when is it not worth using the portfolio loan? And that I was actually about to make that same point. Now, if you are looking to get rid of some of the properties within the next 5 years, this is not something that you're going to want to be using, as there is a partial release fee. So just to briefly explain what exactly the partial release fee is. So say you have multiple properties, you're looking to sell off one of the properties among your portfolio. Now this property currently has 100,000 left in it. Now there is going to be a 20% partial release fee. So what that would look like in this scenario, now you have this $100,000 property that you are looking to pull out of the portfolio loan so that you can sell it off. In this scenario, that 20% release fee, you would be paying $120,000 to A, take that property out of the loan, and B, pay that partial release fee. So that is an area where, especially if you have fewer properties in the portfolio loan, you're really going to want to make sure that those are all properties that you're willing to hold on to for a long time, as there's no need to take that partial release fee where you could just take out another individual loan for that. However, this is a great tool to use with the portfolio loan if you are looking to hold on to these properties a bit longer. Now, looking at what some of the limiting factors with the portfolio loan are. So we are going to be looking for that 100,000 minimum property value requirement. However, with this program, we are able to go as low as 75,000 for individual properties within the portfolio, so long as the average value of that portfolio loan is at least 100,000. So what that would look like is if there are several $150,000 or $200,000 properties, and there was one that came in at 80,000, with the 30-year program, we wouldn't really be able to work with that $80,000 property. However, with the portfolio loan, seeing that all of the other properties are higher and that the average property value among the portfolio is above 100,000, that's an area that we would be able to work with it. Another limiting factor is going to be the DSCR, or that debt service coverage ratio. So coming back to that and the 1.1, we are going to be looking at all of these properties individually within the portfolio. And that does also mean we will be looking at the debt service coverage ratio for all of those properties. So,
Hey, I'm sorry, Connor. Just I know I'm going to ask these questions towards the end, but one of the questions is, can we use this for new investors or for those with experience? And
yeah. So, sorry, go ahead.
no, that's it. That's from Samantha Courts.
Okay. Yeah. So this is absolutely something that a newer investor can use. Now, you would want to make sure that you have the properties when you're going to do this portfolio loan. So I guess in that sense, if you're brand new and don't have any properties yet, then this may not be for you. If you do have the properties, or if you're looking to purchase multiple properties at once, this is something that you would be able to use. But again, I would like to emphasize that the portfolio loans are for those long-term holding properties. So this isn't going to be the program for you if you are looking to just hold on to this property for a couple of years and then sell it off.
Hey, Connor?
Yes.
And just a more of a finer point to answer Samantha's question, all of the products that RCN offers are great for first-time investors, whether it's a portfolio loan or any of them. Certainly, as you gain experience, you're going to save money or get offered better loan terms. But a brand new investor can do the flip, can do the 30-year or the portfolio.
Yes, absolutely. Yeah, we have no problem working with new investors. And as Tim did mention, especially more so with the ARV program or that fix and flip program, as you become more experienced, you'll get those higher leverages and lower interest rates. But we have absolutely no problem working with new investors.
Sorry if I threw you off track there, buddy.
No, you're good.
And Samantha says, thank you. Hey, Connor, I'm going to ask a real quick one because, again, since you're on the credit score, what is the rate for 789 FICO? Developer since 2005, professional project manager consultant since 1985. But if you have a FICO at 789, are you at liberty to say the rates right now, or is this something
Connor, do you want me to help you with that one, buddy?
Yeah, I mean, yeah, you can, if you have anything more exact, but you would qualify for the highest leverages and the lowest interest rates for this program. But yeah, go ahead, Tim.
That's exactly right. So one of the great things about Connor's program is that 789 FICO is going to get you that 80% max LTV if we're talking about the 30-year stuff, right? And it'll also open up the very low interest rates. You'll get something in the fours will be offered to you. It's all about how much do you want to buy down the rate. So a 789, maybe the base rate that you're going to be offered is making it up, let's say 549 to 599, but you can always pay an extra half a point or a point and get it to that 475 mark. So they're very flexible with building a rate that suits your perfect needs. So you can have minimal down, so minimal closing costs and fees, and have a slightly higher rate, or you can buy the rate down a little bit, which I recommend to all of our borrowers, because if you're intending to keep this thing for more than 3 or 4 years, buying down the rate always breaks even within 30 to 33 months. So 789 is a phenomenal FICO. You're going to get the best rates possible.
Absolutely.
Thank you, Tim.
So getting back to that DSCR though, when it does come to the limiting factors with the portfolio loan, now making sure that you have at least that 1.1 is going to be important, because as you're going through your properties, if one of them doesn't hit that 1.1 DSCR, but say you do have that 789 FICO score, that DSCR could be limiting the amount of leverage that you are able to pull out. So there are some situations where it is worth leaving out one property. Say if it's in an area that has extremely high taxes, it is cash flowing, but the DSCR just isn't quite as high as you would like there. That is a scenario where it would be worth leaving out one property just to make sure that you do have that debt service coverage ratio above 1.1 to enable you to get that maximum leverage and lowest interest rates. Now, so what information is RCN going to need for a portfolio loan? So you will be sent over basically an outline via Microsoft Excel. However, I did try to put a picture of that on here and it looked horrendous. So I typed it in as bullet points just to sort of give you guys a good idea of what we are going to be looking for as we're looking at each of these properties in the portfolio loan. So things that we're going to be needing are things like the property address, the property type. So is it a single family? Are there multiple units? Again, with this portfolio loan, it's only going to be 1 to 4 unit properties. So if it's 5+ units or a mixed use property, that's not something we're going to be able to work with in the portfolio loan. We're going to be looking at property dues. So what is the annual insurance? What are the annual taxes? Is there an HOA fee? Is there flood insurance? Then we're going to be looking at the occupancy and leasing status. So what are the market rents in the area versus what the actual rent for that property is? We're going to be looking at the purchase price, the as-is value, the purchase date, any sort of remaining debt on that property. And then we're going to be looking at if there's been any rehab completed on those properties. Now, there is a bit more, but these are really the core ones that we're going to be looking at as we're putting together your loan. Now, again, just to touch on how to get the highest leverage and lowest interest rates with this program. So for the highest leverage, it is very similar to our 30-year program. So we're going to be looking at that 720 plus FICO score in order to get into that top bracket for leverages, with the 760 plus to get you those lowest interest rates. Now we are going to want to see that the property is occupied. The more occupied it is, or the higher occupancy percentage it is, the better that property is going to cash flow, which will also help. And then there's going to be the closing points for the interest rate. So if you are looking to get that lowest interest rate, as Tim had mentioned, it is worth buying down that interest rate with points, especially when you're looking to hold these properties longer term. Now, I will say some situations, such as with the ARV program, where you're not looking to have that loan for very long, it may be worth paying fewer points on closing and having that slightly higher interest rate because you are exiting that loan so quickly. But with the portfolio loan and 30-year loan especially, it is almost always going to be worth paying slightly fewer or slightly more points on closing to get that slightly lower interest rate. Now, just to go over some quick case studies, and I will go over this really quickly, and then I do know that you, Tim, have an example that you wanted to share that you're currently working on. So just to go over a quick case study of what the purchase process would look like. So say in this example, we have a property that has an as-is value of $500,000. The borrower is purchasing it for $450,000. There's a $100,000 rehab budget, and the anticipated after repair value is $750,000. In this scenario, it's going to be a single family property. The borrower is going to have a 729 FICO score with 11 completed flips in the last 3 years. So with this information, we would be able to lend up to 90% of the purchase price, which would provide $405,000 for the initial advance. And then just to make sure that the total loan does not exceed that 75% of the after repair value, we have the $405,000 initial advance, as well as the $100,000 rehab budget, which when divided by the after repair value, will provide 67.3% of the loan. Now, for this loan scenario, given the 405,000 initial grants plus the 100,000 rehab budget, this would produce roughly a 7.79 interest rate, assuming 2 points to RCN. Now, I would again like to mention that when it comes to the interest rates and points on closing, these are things that are negotiable. This scenario is just an example of what it would look like at 2 points. Now, Tim, I know you had an example that you wanted to talk about for this.
Yeah, so when I saw this slide here, Connor, I thought, a lot of the stuff that I'm doing are much smaller price points, right? And also for sort of newer flippers. In fact, I'll digress for just 1 minute, and I promise Anthony it'll only be 1 minute. Probably 6-7 years ago, I had a single mother come to me, just went through a divorce with literally nothing, right? Today, she's my #1 borrower. She's got a portfolio of 50 plus homes. She's doing, 10 or 15 flips a year, but they're at price points below what you've shared here. And why this works so well for her and for investors like her is that, look, her most recent flip, she bought it for 70. We had a 50K rehab. So she's basically closed on that flip for about $10,000. He had done her rehab and sold it for, could have sold it for 225, opted to refinance it. And when she refinanced it, she was able to get 75% LTV, which she completely paid off her flip loan. She ended up with roughly $30,000 in cash at the closing for her 30-year loan, which she got her $10,000 down payment back, right? And she still had $56,000 in equity. I know I'm throwing out a bunch of numbers. The point of this is, Connor, is that when people sell a flip, there is a tax implication to that. I am not an accountant, and I'm not giving you tax advice. I am just telling you that by doing the BRRRR method, when you do that refinance and you get your down payment back and you get some of your profit back, that is debt. That is not income. And you are kicking that tax can down the road, which is what we should all endeavor to do. So whether it's Quickline Capital, me, or if it's Connor and his folks at RCN, the wonderful thing about this program is, we'll talk through the numbers for you, share exactly what your scenario is going to cost you, down payment, interest rate, all of that. We'll even tell you if we think it's a good deal. I'm sure, only from my experience of speaking with 20, 30 borrowers a day, Connor, that debt service ratio that you keep mentioning is maybe a little confusing. Ultimately, that debt service ratio just measures to a lender how profitable that property is. So by sending a deal to RCN, you can, before you've even pulled the trigger on a property, can get a professional and an expert's opinion to say, hey, there's probably better deals out there. This one barely makes any money in the best of days. I'd walk away. So it's just, throwing that out there, Connor, that, these purchase prices can be far lower. That 100K minimum you have for the 30-year loan, a lot of times people are getting to that 100K minimum by buying a $70,000 property and putting 10 or 15 of quick, rehab into it to get it now worth 119 or 129. And let me tell you, if you build a portfolio of $250,000, $115,000 properties, you've created quite a legacy for your family.
Oh yeah, absolutely. And that is another beautiful part of this, the BRRRR strategy, is that you can be purchasing these properties for less than 100,000, putting a little bit of rehab and elbow grease into it, and then easily exceeding that 100,000 mark. But yeah, so this is roughly what the purchase would look like for this. And then moving on to the post renovation. So this is where you're going and refinancing out of this property. Now, again, not all properties are going to be as expensive as this one. But in this scenario, this is going to be that same single family residency, 729 FICO score, 12 completed flips in the last 3 years. And then it's going to be roughly $6,000 for the monthly rental income, $16,000 annual property taxes, $3,000 for the homeowner's insurance. And in this scenario, RCN would be able to lend 75% of the as-is value, so we'd be able to provide $562,500. And what the final loan would look like is the $562,500 with an interest rate of 5.9%, assuming 2 points to RCN. Excuse me. And now looking at the repeat aspect of this. So looking at the two previous loans, so if you take that $562,500 on the cash out refinance that you received at the tail end of this, you can pay off your existing renovation loan of $505,500, leaving the borrower with an extra $57,000 to contribute towards their next project, pay off some of the closing costs, etc.
I'm gonna just to interrupt you quickly. I'm sorry. Can you back up 2 slides? I want to see what they put down on their first, the cash out of pocket to get the property. So roughly, so they put down 45,000. So they've effectively gotten into a $750,000 property, no money down. Great.
Yes, exactly.
People call me every single day for a no money down loan, and they don't exist. Nowhere in this country do they exist. If you ever hear of a no money down program, you're probably being scammed. I would keep your radar on high. However, using this strategy is where you can get the no money down.
Mhm.
Sorry,
Yeah.
go ahead.
No,
I'll stop interrupting you, buddy.
you're good. Yeah, so with this money, or with this method, you will allow your client to get out of those higher rates seen in the ARV program as quickly as possible, while allowing you to keep that cash flowing property. And with the money the borrower receives from the cash out refinance, they'll be able to gain that additional $57,000 to use it as a down payment for the next property. So really, this process is all about taking a property, fixing it up a bit, increasing the value of it, then refinancing out of it, pulling that equity out of the property, and then using that to go ahead and go get that next property to repeat the process so that you can continuously expand your portfolio while also adding all of those cash flowing properties to you. Now, this isn't going to provide the most initial bang for your buck. You will still be adding all of these properties to your portfolio and increasing your net worth. However, the real bread and butter of this is as you go on, as you continue to build this portfolio, as you get those 10, 15 properties that are cash flowing and paying you every month, that's where you really begin to reap the benefits of this. And now, Tim, I know that you said that you would go into the method comparison a little bit, so I'll let you take off.
Sure. So I'll back up and just to touch the last point on what you just covered. You don't have to back the file up. You know, when you're doing these loans, Connor, you're loaning to folks LLCs, right? And,
Yep.
and that's a huge difference because having the loan, 50 loans with your LLC does not hit their personal credit reports, right? Sure, there's an inquiry to make sure that they have that 729 score, but ultimately their personal credit is not impacted unless, you know, they ever defaulted. You know, when you look at local credit unions who are sort of trying to do stuff like this now, you know, they're going to max out at maybe 2, maybe 3 properties for you. And then it's going to destroy your personal debt to income ratio, which doesn't matter to RCN, right? We don't look at, you know, personal income or tax returns for that matter. So I just think a very important point, Connor, is, you know, looking down the road and looking at how you truly build this wealth. There's no limit. Literally, Connor, I think that you will probably do 1,000 loans for an individual before you had any concerns. And I don't want to put words in your mouth, but I've never had you walk away from a borrower, and I've got borrowers with, you know, 50 to 250 properties. That was for you to jump in.
To my knowledge, there's never been too many properties.
Okay, and that's a great one. So if you want to jump into that next slide, sorry, making you back and forth here.
Oh, you're good.
Yeah, so you know, there's a couple ways that, you know, a new person into this industry or even existing can look at this. And what I'll talk about again is, you know, sort of the tax implications with doing this. You know, the first method that is up here is, you know, they got the fix and flip. They use the profit to buy a new flip. They do it again. They'll buy another flip, and they're continually building that, you know, that value and that net worth by continually doing flips. Now, while I have borrowers that do 10, 20, 30 of these flips a year, this is a great strategy for building up liquidity. However, there's pretty severe tax implications to you making that much money that quickly. When you go down to the next strategy down here, which is the buy and hold, and basically the BRRRR method is at the bottom. We should have named these BRRRR method and old-fashioned method. When you get to the BRRRR method, you're building that same liquidity and you're building that same net worth, but you're doing it without the tax implications. Also, instead of you having, and I'm making up an example, if you did 5 flips this year using the top option, maybe you made 250,000 cash. You're going to pay some taxes on that, and maybe you're left with, and I'm making it up, 160 cash. If you do that same strategy down below with the BRRRR method, you might not have that same 160 cash. Maybe you've only got 140 cash, but you haven't paid those taxes, and you've got about 160,000 in equity in those 5 properties. Plus, as Connor mentioned, they should all be cash flowing and making you money every month. It's a no-brainer. The whole BRRRR strategy is become widely popular because of this, right? And in the coming years, you can really quickly build up your portfolio to get to the point to wherever you're comfortable. If you're asking me, a guy who not only funds 20, 30 of these a month, but also has some of his own, I am telling you that the BRRRR strategy is really something to look more into. RCN is perfectly equipped to help you execute that BRRRR strategy. And if you're looking for additional reading, there's the book, the BRRRR strategy. It was written by this gentleman who opened biggerpockets.com, a site that you should all be on. Anyway, sort of a digression there, Connor, but that's just my opinion. It's what I see. The most successful borrowers that I have, as far as terms of net worth and cash flow, are using the BRRRR method.
Yeah, absolutely. And I think an underrated aspect of this too is also the fact that when you are going with the fix and flip method or the older method, you are seeing those larger payoffs when you are selling that property, and you are receiving those higher taxes or short-term capital gains. But with the BRRRR strategy, you're still getting all of that. It's all compounding as you continue to go. Whereas if you're doing 2 flips a year, you may get a little bit quicker, a little more efficient, maybe get to 3, but you're still going to be fairly static in the amount that you'll be able to take home. Whereas when you're using the BRRRR strategy, you're adding properties to it, and it just continues to compound for larger and larger gains each month as you are receiving payment from those cash flowing properties. So it really is, it's a little bit slower in the start than the fix and flip method. However, there's no ceiling to it, whereas you can only complete so many fix and flips in 1 year. So I just think that that's another aspect to look about when you are thinking about going into this BRRRR strategy. It really is for the long-term wealth. And now, so these are some common questions that we pulled from the previous webinars. However, Tim, I'd love to take a second and just pick your brain a little bit. Now, I do know that there are a lot of things that you do fairly regularly to help aid you in all your success, such as, and I think my favorite quote of yours is the never eat lunch by yourself. But if you have any other advice that you think these brokers could use, any other tips that have helped you in your success over the years, I'm sure that they would all love to hear a little bit.
Yeah, absolutely. I mean, number one, I guess, would be just be the expert in your space. Knowing these RCN programs back and forth become very, very easy to sell. I hate to use the word sell, but to sell to potential borrowers. But more importantly, yes, going to get the potential borrower is going to put food on your table and you're going to make money this month. But by going to the realtors and the owners of these real estate agencies is really where you're going to get the biggest bang for your buck. COVID is an excuse for the weak salesman. I've done just as much, networking and hosting events, much like this thing here, throughout COVID as I did before COVID. Was it easier in person before COVID? Sure, I guess so. but everybody's out there still trying to eat. And if you give an option to a realtor or the owner of a real estate agency to do more business, they're going to take your call and they're going to take you seriously and they're going to send you referrals. That's just my easy answer.
It's a good answer. Hey, Connor, I just wanted to ask a real quick one before we get away, but guys, maybe Tim, you can answer this as well. With the current mortgage rates at 2.5, and I recently, Ron Lorenzo, recently secured a construction loan at 3.25. What would these commercial rates be with a FICO score of 800?
So a 3.25 construction rate, I would take that and I would run. That is probably the greatest rate I've ever even heard of. Most lenders aren't even doing new construction now. But once that property is complete, you could expect, I mean, I don't know the property and I don't know how well it's going to perform debt service wise, but that 800 score is going to open you up to a rate in the fours.
Got it. Thank you, Tim.
Anyway, so I see your the questions, Connor, and they're the same ones that I get, 10, 20 times a day. I think that, most of these questions are actually your competitive advantage, right? So when people are asking about the docs, it's a very simple. Say, I don't even go into that list. I say, listen, let's get ready to roll. I'm going to send you a short doc list this afternoon. We'll get this file started today. It's only 6-7 docs. Takes most borrowers less than 15, 20 minutes to pull them together. And it's true. I think most of the loans I've funded with you, Connor, have been 7 docs, right? 2-3 weeks of underwriting and we're clear to close. Again, we're all sort of beholden to these appraisers who are slow right now. And it's just a function of everybody on the planet is doing a refi. So getting an appraiser to want to do an appraisal costs a little bit more and takes a little bit more time right now. But these are good problems to have as far as I'm concerned. Anthony, I wasn't keeping up with the questions in the chat, but I did see a few.
Took care of them all. We took care of them.
Great.
Got them all.
Thank you.
Yep. Usually I will ask Connor towards the end of the session, but I figure let's throw them in right now. This is good, guys. This is good. There is a long question from Alan, but we're going to send that question to Connor and Erica and Jeffrey at the end. Okay. There is a very long question. So guys, man, I felt like I went to a university class. That was extremely informative. Thank you, Tim. Thank you, Connor. That was really, really good. I learned a lot. And I do have a few clients that I am going to be sending to you directly, Connor, so you can help them because they definitely need your help. Okay. So, but I do have some questions, Connor, from some attendees that weren't unable to get onto this live Zoom. How many properties can fit into a portfolio loan from George Eliopoulos?
Yeah, so there really is no limit to how many you can put into a portfolio loan. We are going to be looking at each of those properties individually to make sure that they work with us at RCN. But as long as they meet all of the minimum requirements, as long as the cash flowing and they're occupied, there's really no limit to how many properties we can fit into a portfolio loan.
Great. His second question is, when should my client be looking to consolidate into a portfolio loan?
So I'm going to answer this one, and then if you have anything you want to throw on top of it, Tim, go for it. But really, I think you should be looking at getting into a portfolio loan if you have multiple properties, say they're at a higher interest rate on a stabilized bridge. You have properties where their current loan is coming up to its maturity date. Really, you're going to want to make sure, again, that all of these properties you're looking to hold long term. But if you have a plethora of properties, you're making multiple payments to different lenders, that's a great opportunity to consolidate into one loan under the portfolio loan. But Tim, if you have anything you want to add to that?
Yeah, no, I mean, I agree with you 100%. The long-term investment horizon is the first thing that I make sure that that's what the borrowers are going to want. And then the second thing, I know you can do a 200 property portfolio. My recommendation is, hey, one check is sweet, but it's okay to have 5 checks with 10 per property, because the last thing that you want to do is have that 1 or 2 properties title issues slow up the closing of 100 property portfolio loan, right? So if you had broken that portfolio loan up into groups of properties, you would be able to close on 2 groups and then you have that little problem group with, because I don't care, when you get to 100 properties, you're going to have title issues on a call. So I just like to keep them, 10, maybe 20.
Very good. I have another question from Eve that was unable to, Eve Rivera from Prime Plus Realty. Do the properties need to be located in the same area to use the portfolio loan?
So the simple answer is no, they don't. Now, it may help with some of the appraisals. If you can get the same appraiser to hit multiple properties, that may help to reduce the price of that appraisal. However, it really doesn't matter as long as it's in a state that we're able to lend in, which is every state other than North Dakota, South Dakota, Minnesota, Vermont, Alaska, and Nevada. As long as it's not in one of those states, then there's no issue with having multiple properties in multiple states under one portfolio loan.
Great. Hey guys, this literally concludes. I don't have any more questions here, and I don't see any more other questions. So this concludes our 3-part series with RCN Capital. And I really want to thank you, Connor, and thank you, Tim, as well. Again, this was a really great one. I really enjoyed it, very informative, and I learned a lot. And so, guys, I do want to say thank you, and thank you to our sponsor, RCN Capital. Tim, we're going to see you soon, maybe in a couple weeks, I guess. And there will be another RCN Capital panel with Tim on it, and with an attorney and a broker and a banker and a title company. So that's going to be really exciting to see. And I'll make sure that everybody that registered for the RCN will get also a sneak peek of that banner that will be sent out in a couple days, that will be coming up in 2 weeks. So once again, thank you, RCN Capital. Thank you, Connor Hibbs, and thank you, Tim Maloney. And it was a real pleasure, everybody.
Thank you, Anthony. Get something closed today, Connor.
I'll do. You too.
Thanks, everybody. Bye-bye.